Federal Reserve Chairman Jay Powell shedding some light on future rate hikes while speaking at the Wall Street Journal's Future of Everything Festival yesterday. Watch.
Starting to see what we need to see, which is a really clear and convincing evidence that inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down.
My next guest interviewed Powell yesterday at that festival. Joining us right now is the Wall Street Journal's chief economics correspondent. He is the author of Trillion Dollar Triage. Nick Timiraos is here. Nick, great to see you.
Thanks for having me.
Congrats on another interview with Jay Powell. It was great. What was your takeaway? Tell us what was most important about that.
Well, you heard in that clip, he said they want to see clear and convincing evidence that inflation is going to come down before they slow down their pace of rate increases. Think about what they're doing right now. They raised interest rates this month by a half percentage point. The Fed hasn't done that since 2000. They're raising rates at consecutive meetings. When Alan Greenspan was raising rates by half percentage points in 1994, he wasn't doing it at every meeting. He was taking a break, meeting, break, meeting, break. So they're going fast. And when you go fast, there's a risk that you overdo it. It's hard to know when to start raising rates. The Fed saw that last year. And it's hard to know when to stop. And so when you go this fast and you want to see clear and convincing evidence of a lagging indicator, inflation lags the economic data, you raise the risk that you tighten too much.
One speculation going into the last CPI number on Wednesday was that, maybe inflation is peaking, right? You heard that from a lot of people, right? I was hearing that from many Wall Streeters saying this could be the worst of it. It really wasn't. We got the PPI at 11%. We got the CPI at 8.3%. Are there any indications from your standpoint that so far the rate hikes have actually moved the needle on inflation?
Well, you certainly see it in the housing market, right? And so people who were looking to buy a home 6 months ago when mortgage rates were at 3%, now mortgage rates are at 5.25%, 5.5%. That changes the monthly payment. That changes what you're able to afford. So we won't see that in the data for home sales right away, and it'll lag even longer in prices. It'll take a year for that to work through the system, but you could see it eventually.
What do you think?
Yeah, we're going to see, I think, later this morning, more evidence of a declining housing activity. Mortgage applications from potential home buyers will be down year over year. We're looking at deep year-over-year plunges by mortgage applications for refinancings. That's telling me that we're going to get, less support from lower what had been lower interest rates for consumer spending. And you're very correct by noting that this is a lagged effect. We're not going to feel the full impact of higher mortgage yields, of higher interest rates until perhaps 6 to 12 months from now, and that's the problem. The Fed doesn't know how much economic activity, how much spending is going to be lost to higher interest rates, and that is why there's a very good chance that we have a recession within the next 12 to 18 months. But then Powell warned us, no pain, no gain.
Yeah, it's interesting to hear the Fed chair say there will be some pain, right? It's interesting to hear the Fed chair say, well, maybe we'll have a soft-ish landing. He talked yesterday, really, the most I've heard about maybe the unemployment rate is going to have to go up. And they're hoping that it'll go up just a few ticks. But when the unemployment rate goes up a little bit, it usually goes up a lot because you're going into a recession.
Well, that's a great point. And that's what I was asking earlier. Are layoffs next? The chairman spoke about the ability to achieve this soft landing in your interview yesterday. Let's take a listen.
But while also having a strong labor market. Doesn't mean that the unemployment rate needs to remain 3.6%, which is a very, very low rate, historically low. It's 1/10 above the 50-year low. You'd still have quite a strong labor market if unemployment were to move up a few ticks. So I would say there are a number of plausible paths to having a soft, or as I've said, soft-ish landing. And our job isn't to handicap the odds; it is to try to achieve that.
Nick.
Well, when the unemployment rate goes up a little bit, it goes up a lot. And so when you have the Fed chair saying maybe a 3.6% unemployment rate is too low, that's saying something. That's important. The Fed worked very hard last year. They wanted to try to drive the unemployment rate down. They were trying to go to that 3.5%, which is where we were before the pandemic. Now you see a broader recognition that maybe the economy has changed. Maybe we're not going back to the economy we had before. There's more price pressures built into this economy. We have labor shortages. Businesses are changing inventory management. What used to be just-in-time management, now it's just in case. You want to have multiple suppliers. That builds in cost. And so the forces that help central banks, because it's not just in the U.S., it's in Europe, that brought inflation down, if those forces are reversing, it's just going to be a much more difficult environment for the Fed and Jay Powell.
You know, with the jobless rate, the record is very clear. Each and every time you've had the unemployment rate rise by, say, more than 0.3 of a percentage point, you have had a recession. So it doesn't take much of an increase by the jobless rate to push the economy over the cliff.
What were you going to say, Jen?
I just was going to say, I was watching the action yesterday and listening to Powell at the same time. He is saying there's going to be more pain ahead. We know that's coming, but then the stock market didn't really react to it. Stock market moved up higher, although the futures are down this morning. And so I wonder, this volatility that investors are experiencing right now, how are they supposed to read the tea leaves to understand what's actually going on?
And you just pointed to what has gone on in the past, Nick.
Yeah, well, I asked Powell about this yesterday. What's the historical example for achieving something like this, bringing down inflation when it's this high, the unemployment rate's this low? And he said, look, we may not have an example of this, but if you look at what the economy's been through over the last 2 years, we haven't really lived through anything like that either. So we're kind of flying blind here. And, it's going to take some luck to pull this off.
Is he going to have to go back to that comment that he made that we're not going to go 75 basis points and go 75 basis points?
The 75 basis point thing, it feels a little pedantic right now. They have this strategy of going a half point a meeting.
Yeah.
75, I think you see that if they get very alarmed.
Yeah.
If inflation expectations begin to come unglued, it's more of a... you're not talking about a soft landing anymore if you're doing 75 basis points.
Well, it certainly feels like the estimates have to come down. You said earlier, second half of the year, they're expecting what kind of profit growth?
10% earnings growth, EPS growth, S&P 500. It's not going to happen. Regarding the Fed policy, Powell is lucky that for the time being, you have a strong dollar exchange rate. You got problems overseas. So that gives him a little bit of breathing room if he wants to use it as far as raising rates. He doesn't have to tighten that aggressively. We don't see foreign investors that hold a lot of Treasury securities demanding that the Fed tighten more aggressively to halt this rise by inflation.
Final word, Nick. We got to jump.
Yeah, this is low-hanging fruit, right? It's easy to raise rates a lot when the economy is still chugging along, which it is right now. So this is the easy part. Second half of the year, maybe that's the hard part.
Well, go ask Target about that, right? Stock is down 22% right now. Nick, it's good to see you.
Thanks so much for having me.
Thanks very much. Nick Timiraos joining us, Wall Street Journal.